Sometimes, market chart scenarios occur where the price, instead of taking support from our order block and moving upward, breaks through it and treats that same order block zone as resistance. This often creates confusion about whether to take a short position or go long. So, in today's video, we'll discuss what breaker blocks are in smart money concepts. But before we dive in, if you find this content valuable, hit that like button, and if you're new to the channel, make sure to subscribe and turn on notifications so you never miss any of our upcoming uploads. I'll catch you right after the intro and disclaimer. In this chart, the price retraces to its swing high. After identifying these points, the price moves downward and then rapidly pushes upward, breaking through the previous swing highs. Here, we can see a break of structure, where the last red candle below is recognized as a valid order block candle, and we mark this area as our order block. Now, when the price returns to this zone for the first time in the future, we expect a reversal from this level and prepare to enter a long trade here. However, in some cases, instead of reversing from this point, the price breaks directly below our order block, suggesting that the order block has been completely invalidated. Since this downward movement has broken through our order block, we refer to it as a breaker block, as the order block has been breached. Therefore, whenever the price breaks a valid order block and closes below it, that order block transforms into a breaker block. Previously, our order block acted as support, but once it breaks, it converts into resistance due to becoming a breaker block, causing the price to move downward while taking resistance from that level. This means that if a bullish order block breaks in the market, the resulting breaker block acts as resistance. Conversely, if a bearish order block breaks, it serves as support. This is the reason traders often get confused about which direction to take a trade in such conditions. Once an order block breaks in a certain direction on the chart, its function also changes accordingly. For instance, after a bullish order block forms on the chart, we wait for the price to take support in this zone, treating it as a demand area. Similarly, in a bearish market, the order block created is viewed as a supply zone, and we plan a short entry, expecting the market to drop from this resistance level. However, because of the trend reversal associated with a breaker block, many retail traders end up entering trades in the wrong direction. Just as there are specific rules for identifying a valid order block for trade entries, there are also essential rules for recognizing a valid breaker block. Moreover, it's important to understand the psychology of buyers and sellers behind how a breaker block forms on the chart. Let's understand the psychology behind the breaker block. As we know, after a valid break of structure, when the price first approaches the order block area, many retail traders place limit buy orders to open long positions at this level. However, once the price dips slightly below their entry point, these buyers begin to panic and hope for the price to climb back above that area. At this point, the order block that was previously serving as a demand zone now turns into a supply zone due to the breakdown. As the price tries to move above this level again, some new traders, noticing this resistance, start taking short positions. This increases the selling pressure around that area. Moreover, the initial buyers, who had entered long positions earlier, begin to close their trades near their entry levels without any profit. This further adds to the selling momentum, and the price declines rapidly. This happens because of the fear that the market might continue falling, causing panic among traders and disrupting their decision-making psychology, ultimately leading to losses. Therefore, whenever you plan to enter a trade, it's essential to first understand what's happening in the minds of buyers and sellers. Only then can you confidently take a short position without hesitation. Now, let's move on to some of the key criteria or rules for identifying breaker blocks. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this October 18th. This isn't just another course, it's a complete system to master smart money concepts, manage risk like a pro, and build consistency in your trades. And here's the crazy part, it's only $500, plus 61% off for pre-bookings before October 18th. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. Rule number 1. Whenever a breaker block appears on a chart, The price must first sweep liquidity from both sides. As shown here, the price has cleared liquidity entirely, both the sell side above and the buy side below. Rule number 2. A breaker block is only valid when the price fully breaks the order block, either above or below it. The closing of the breaking candle must occur beyond the breaker block level. Only then can it be considered a valid breaker block. If the breakout candle simply forms a wick and then moves back in the opposite direction, it becomes an invalid breaker block. Rule number 3. A breaker block can be used only once. Once the price crosses that level, it's no longer valid. If the breaker block itself gets broken, it becomes ineffective, and we cannot rely on it again. Now, these are theoretical or textbook rules, which often look great on paper but can differ in real market conditions. Sometimes, the price breaks above the breaker block on the chart and then sharply reverses after sweeping liquidity. This can create confusion. For example, let's examine the 3-minute time frame chart. The market first moves up rapidly, creating a small high at a higher level, and then breaks it again. This action forms a break of structure, allowing us to mark an order block in that zone. However, as the market soon declines, our order block gets broken since the price closes below it, thereby forming a breaker block. Now, based on the theory, the market should take resistance from this area and move downward. But in practice, that doesn't always occur. The price closes above our marked zone, leaving traders uncertain about whether to go long or short. Some even enter long positions here, only for the market to reverse sharply again, trapping those traders. In such a setup, as soon as the price breaks below the breaker block area, you can capture strong short opportunities by entering a sell trade at the closing of the breakout candle, using a small stop loss. However, in these cases, it's wise to partially or fully book profits once your target exceeds a 1-to-2 risk-to-reward ratio, as sudden reversals are highly likely. That's why quick decision-making is crucial in these scenarios. Acting swiftly allows you to capitalize on these high-probability setups effectively. That's it, traders. Thanks for watching this video. Champions are built in moments like these, when you decide to learn instead of give up. If this video added even a bit to your trading growth, hit that like button, and if you're new to the channel, make sure to subscribe and press the bell icon for more daily insights. Stay focused on your goals, stay passionate about the journey, and I'll catch you in the next video.